And if you'll give me just a second, I'll get that text open for you. Okay, you should be able to see your textbook. I'm going to start over on page 1278 of your textbook, and we're going to talk about present value techniques today and concepts. You will remember that the last time that we met, we were talking about buying assets that were going to be assets that were plant assets or assets that we had intend or we are thinking about investing in this chapter. So for capital investment analysis, what the company's doing is they are thinking about buying some type of asset, and what they're going to be looking at is whether they should buy one asset over another asset that they might be looking at. So the company might be looking at two or more assets at one time, and they need some kind of system to evaluate these assets. So the last time that we met, we talked about calculating the average rate of return on the investment, and we also talked about the cash payback period. Well, today I want to get more into the present value techniques that we would use to evaluate prospective assets that we're thinking about investing in for our particular company. And so one of the techniques that we can put our assets through to see if they pass the test that management wants before we would actually invest in these assets is called the present value concepts. We're going to be looking at the present value of a concept as far as the cash flows that we think that this new asset will bring to our particular company. We're going to look at the present value of that amount of a lump sum amount, and we're going to be also looking at what we call the present value of an annuity. The present value of an annuity is a series of equal payments that we are expecting to be receiving in the future from our assets that we're thinking about investing in. So when we look at the present value of an annuity, we're going to look at the cash flows that we think that this potential asset, this asset that we're thinking about investing in is going to bring to our company over a series of years. And the present value of an annuity is the cash payments that we are expecting in the future from this particular asset. So before we look at the actual evaluation methods that we're going to be using on our assets, we really need to look at how to calculate present value of amounts, and we would look at compounding of interest. Now, up until this point, we've talked about calculating simple interest. In this chapter, they're going to broaden that to calculating compound interest. So when we're talking about present value techniques, what we're going to be looking at is the compounding of interest over a period of time. So in your textbook, the page that we're looking at right now, they've given us an example of how to calculate present value. It says, for example, if you were given the choice, would you prefer to receive $1 now or $1 3 years from now? And so what we should choose is to receive $1 now, because we could invest that dollar now and it will grow and earn interest for a 3-year period, if that's what we were looking at in our particular example. So in this example, they're saying that, would you rather receive $1 now, or would you rather wait to receive it $1 3 years from now? And the choice would be that you would want to receive $1 now, because you could invest that money now and grow interest on it. And so if we are looking at an illustration for just $1 amount that we are thinking about being invested, and we want to know how much that dollar amount that we've invested could grow in a period of 3 years, if we had an interest rate of 12%, then we could gain some interest off of this dollar amount that we would have invested. So after 1 year, if you invested $1 at 12% interest, we would take $1 and multiply it by 12%, and that would give us 12 cents in interest that we would earn by the end of that first year. So if we have earned 12-cent interest by the end of the first year, we could take that 12-cent interest and add it back to the original amount that we have invested, and then invest that total amount. So in other words, at the end of the first year, our $1 investment would have grown to $1.12, and then we could invest that $1.12 at 12% interest to see how much it would grow to at the end of year 2. And at the end of year 2, we would earn approximately 13 cents more that we would add back to the original amount that we had invested. So we could take the $1 that we had originally invested plus the 12-cent interest that we earned at the end of the first year, and then if we invested that entire $1.12 for another year at 12%, it will earn us an additional 13 cents, which means that our investment would grow to $1.25 at the end of year 2. Then we would take that $1.25, invest it again at 12% interest to see how much it would grow to by the end of year 3. And by the end of the third year, your investment would have grown to approximately $1.40. So what I'm saying here is that if we have $1 today, we can invest that dollar and earn interest off of it. If the interest is compounded, it's like we're taking our interest and we're adding it back to the investment at the end of the first year, and then we will take the investment plus the interest that we added back at the end of the first year and invest that for another year, so it keeps growing and it keeps compounding over time. So the present value of a dollar amount today is $1, but if we are going to invest it for 3 years at 12% interest, that investment is going to grow to $1.40. So that $1.40 is technically what we could call the future value of $1 invested today at 12% that's compounded annually for 3 years or 3 periods would amount to a future value of $1.40. They have shown that in this illustration here in Exhibit 1. So you can see that we originally had $1 and we multiplied it by 12%. It would end up being $1.12 at the end of the first year, and then we'd take that $1.12 and we'd multiply it by 12% and add it back the interest plus the investment at the end of year 2 would be $12.54, and then or excuse me, $1.25 basically is what that is. And then we would take that amount and invest it for another year, and it brings us up to $1.40. So that's a visual of what they're doing with compound interest. Now, if we wanted to look at this a little bit backwards, we could say, well, if the future value is $1.40 at the end of 3 years, if we invested $1 at 12%, at the end of the 3 years, that future value amount would be $1.40. But we could also take this and say, if we wanted to know what the present value of $1.40 is that will be received on December 31st in year 3, we could work backwards at that. We could actually use a present value table to help us to calculate the present value amount. And as you can see here, this table has interest rates on it. It also has the years that we are thinking about investing our money for. So in this case, we were investing the money for 3 years at 12%. The table value amount is 0.712. And if we were to multiply this 0.712 times the $1.40, it will give us the present value of that amount, which would equal to $1. So these table values kind of give you a shortcut in helping you to determine what the present value amount would be. So what they're saying in this example is, what is the present value of $1.40? If we're investing it for 3 years at 12% interest, my table value amount will be 0.712. We can take that table value amount and multiply it by the $1.40, and what that will yield us is approximately $1, which is the present value of the amount of $1.40 that is to be received on year 3 at 12% interest. So again, they've shown you the multiplication of the table value amount times the amount that was to be received in 3 years, which was $1.40, and that will take you back to the present value amount of a dollar. So we're still saying that if we invested a dollar today, in 3 years, we could earn 12% interest. If it's compounded, that dollar will end up being $1.40. Now, in the example that we just looked at, that dollar amount that we are investing represents what is sometimes called a lump sum amount. This lump sum amount is a one-time amount that we are investing. So we're investing $1 one time. We're going to leave it in an investment for 3 years at 12%, and that $1 will grow to $1.40. Now, sometimes what we'll want to look at is the present value of an annuity. And again, an annuity is a series of equal net cash flows that are coming at fixed time intervals. There are many types of annuities that are common in business. Some of the examples they give you would be like rent. We know that we're going to have to make a cash payment for rent, and usually rent is a fixed amount, and the amount of rent we would pay monthly would be considered to be an annuity because it's going to be a series of equal cash payments that we have to pay on a monthly basis. So if we pay rent of $1,000 this month, next month we're going to pay another $1,000 in rent, and the next month another $1,000 in rent. So an annuity is just a series of equal cash payments. It's a series of equal cash flows. It doesn't have to be just payments. It could also be cash receipts, because what we're going to be looking at in this chapter is investing in assets. And so we're going to expect those assets to make us money over time, and we're going to expect to be receiving cash from those investments. And if it's a equal amount over time, we call it an annuity. So what we're going to be doing is we're going to be determining the present value of the annuity. And that is the amount of cash that we need today to yield a series of equal net cash flows at fixed time intervals in the future. Present value analysis can be fun to look at, because if you're thinking about retiring in the future, you might want to use present value analysis to help you determine how much you would be able to get at retirement on a monthly basis if you wanted to know if you wanted to have a series of equal payments at retirement. So for example, if I wanted to have $1,000 that I receive $1,000 each month in my retirement years, then finding or playing with the present value of an annuity will help me to know what I need to invest today in order to be able to get a series of equal payments toward my retirement in the future. So there are a lot of things that we can do with present value analysis that could apply to you personally, and there certainly is a lot of stuff that we can look at from a business point of view to help us to determine whether we should invest in a particular asset or not. When we're looking at present value techniques, that can help us to make our decisions. But an annuity is a series of equal payments or equal cash flows. Doesn't have to be just payments, it can be receipts too, but it's a series of equal cash flows that we're going to be receiving in the future at fixed intervals. Now they're going to give you an illustration here of calculating the present value of an annuity. It says to illustrate the present value of a $100 annuity for 5 periods. Again, we're using 12% interest as our amount of interest that we are expecting that we could receive on this investment in an annuity. And we could determine the amount that we would need to invest in this annuity to be able to receive a series of equal payments in the future. By using the present value of annuity table, we can do this. In this example, they are showing you that if you had or if you wanted $100 at the end of year one and you're investing it at 12% interest, the amount that you would need to invest at the beginning of year one would be $89.30. In other words, if we want $100 at the end of year one, we've got to invest $89.30. At 12% interest, the future value of the present value amount that we would invest for 1 year, if we could invest $89.30 at 12%, it will give us $100 at the end of year one. Notice that they've got a table value amount here that they multiplied $100 by to get this present value amount of $89.30. So what they're saying is, I want to receive $100 at the end of each year for 5 years. What am I going to have to invest to be able to do that? And so they're looking at 1 year at a time here, but technically the total amount that you would have to invest at the beginning of the time period would be $360.50. If we could invest $360.50 and earn interest at 12% over a 5-year period, we would be able to get $100 out of this investment each year for 5 years. So what they did is they showing you how they broke this down by each individual year. So if we wanted $100 at the end of the first year, we have to invest $89.30. If I look at my present value of the lump sum table or the present value of the dollar table for 1 year at 12%, do you see where it's 0.893? That's where we're getting the amount that they have multiplied by $100 in Exhibit 4 to get the $89.30. So $100 times the table value amount that came from Exhibit 2 for 1 year at 12% is 0.893. If we multiply that by $100, it will give you $89.30. In year 2, if we're wanting to receive $100 also at the end of year 2, we would need to invest $79.70 to be able to receive $100 at the end of year 2. So if the end of year 2, our table value amount for year 2 at 12% interest is 0.797. 0.797 times 100 is $79.70. You're going to do the same thing for year 3. Your table value for year 3 is 0.712, and that came from Exhibit 2. This is year 3 at 12% interest is 0.712. On the next year, we'd pick up at the end of year 4. The table value amount is 6.636. And so that's how they're getting this amount to multiply by 100, and that would give you the present value of $100 if you were investing $100 at the end of year 4. For year 5, the present value table amount is 0.567. In year 5, since it's an annuity of $100 for each year that we are wanting to receive, we would multiply that $100 times 0.567, and that will give you $56.70. So if you add up each one of the present value of the $100 amounts for each of the years, the total amount that we could invest at the beginning of year 1 would be $360.50. That amount that we invest in year 1 would yield $100 at the end of each of the 5 years. So at the end of each of 5 years, we could get $100 if we were investing $360.50 at 12% interest. Notice we used the present value tables for a dollar amount, which is the Exhibit 2 tables when we were doing this calculation. An easier way to calculate this, since these $100 that we're expecting at the end of each year for 5 years, as an annuity, we could have used the annuity table. And so if we were investing at 12% for 5 years, the present value of an annuity table is telling us that 3.605, this table value amount, if you multiply that by $100, which is the annuity amount that you were expecting in each year for 5 years, if you multiplied this 3.605 times $100, it will give you $360.50. So there's 2 ways that you could go about calculating the present value of the annuity. You could use the present value of the annuity table, or you can use the present value of the lump sum table, which was Exhibit 2. Now, sometimes when we are looking at our investments and trying to evaluate those, we may be able to estimate a series of cash flows that are not equal. if the series of cash flows are not going to be equal, we have to use the present value of the dollar table, or what I like to refer to as the lump sum table, to be able to determine the present value amounts for our assets. If the cash flows are unequal for a period of time, then we have to use the table 2 or exhibit 2, the present value of the dollar table. If the series of payments are equal, then we can use the annuity table. But when you're using the annuity table, your cash flows have to be equal. In the example that we just looked at, the cash flows were equal, so we could have simply gone to our present value of annuity table at 12% for 5 periods, and that would give you the table value amount, and we could just multiply that one time by 100, and that would tell us the amount that we would have to invest at the beginning of the 5-year period to get $100 back each year for 5 years. So this was a series of equal payments. We could have used the annuity table. If it were a series of unequal payments, we could not use this table. If the cash flows that we were expecting to be receiving in the future were not always $100, maybe we were expecting to receive $90 one year and $110 the next year, then we have to use the present value of the dollar table, which is in Exhibit 2. All right, so now in your textbook, they're getting into the net present value method of analyzing our investments to see if they meet the expectations for management, so that we can help management to decide which investment to invest in. This is another method that will help us to do that. The net present value method is one method where we use present value techniques to help us to evaluate different alternatives of assets that we are thinking about purchasing. What we're going to do with the net present value method is we're going to compare the amount that we are expecting that we will be investing in that asset. We'll compare maybe the cost of the asset with the present value of the net cash inflows that we are expecting from this investment. So we're talking about net cash inflows here. And they've given you an illustration of what would happen. Let's say that we were thinking about buying some new equipment and it was going to cost $200,000. We know that this equipment, or we've placed a useful life on this equipment for 5 years. This is what we've estimated, and this is what we're expecting to be the depreciable life of the asset that we're investing in. Its useful life will be 5 years. Management is wanting, in this example, a desired rate of return of 10%. This desired rate of return is going to be our interest rate that we will be using. Notice that we are expecting to be receiving cash flows when we invest in this asset for 5 years, and we're expecting to be receiving cash off of this investment in unequal amounts. Because the amounts are unequal for our cash flows, when we are trying to determine the present value of that asset, we have to use the table for the present value of a dollar amount. We can't use the annuity table because the payments are not equal. An annuity is a series of equal receipts in this case. These receipts are not equal, so we cannot use the annuity table. We have to use the present value of the dollar amount table when we're determining the present value. When you're looking at the net present value method, you must first determine the present value of that $200,000 investment. The way that we do that is we look at each of the cash flows. We're going to look at each one of these separately because our cash flows were not equal. And we're going to multiply each one of the year's cash flows by the present value of a dollar amount at 10%. So we're going to go back to that table that is in Exhibit 2, and we're going to record the table value amount for 1 year at 10%. So I'm going to scroll back to where we had table or Exhibit 2, the present value of the lump sum table of a dollar amount is Exhibit 2. We're going to be looking at 1 year. In this example, we were working with a 10% interest rate. Do you see that they've got 0.909? We're going to multiply that 0.909 by the first cash flow, which is 70,000. So 70,000 times 0.909 is a present value of the $70,000 is $63,630. So if we are expecting to receive $70,000 at the end of year 1, and we can invest that cash flow at 10% interest, then we will be able to get $70,000 at the end of year 1 if we invest the amount of $63,630 for 10% at 1 year. It will yield us $70,000 at the end of that first year. So what we're looking at is we're looking at what we would have to invest today to end up with a series of cash receipts for the 5-year useful life of this asset. We would have to determine the present value of each one of these cash flows separately year after year because these are not equal amounts. We have to use the present value of the dollar table because these amounts are unequal. So in year 2, we're expecting at the end of year 2 to receive $60,000. The amount that we would have to invest is $49,560. I can get that by looking up on my table the present value of the dollar amount at year 2 at 10% interest. At year 2 at 10% interest is 0.826. 0.826 is how they came up with the present value table value amount, which we would multiply by the second year's cash flow, which was 60,000. We would need to invest 49,560 to get 60,000 2 years at an interest rate of 10%. Notice they just took each one of the cash flows and multiplied it by the present value table amount to get the net present value, or excuse me, to get the present value of the investment. Once we've calculated all 5 years, the total present value of this investment is $202,900. Now, when we are evaluating an investment that's going to cost us $200, remember that is the cost, that's the initial amount that we're going to have to pay for the new equipment is $200,000. If we could evaluate that at the end of 5 years, if we're getting those net cash flows off of that investment, you can see that the difference between the cost of the asset and the present value amount will yield a net amount of $2,900. This is a positive amount. So we would compare that with other investments. We would compare the net present value amounts, and this would give us a way to evaluate different investments. So in this case, if we're just looking at this one investment, it would be a pretty good investment because the net present value is more than what you would have had to invested. In other words, your present value amount is more than what you would have invested. So you're to the good at $2,900 if you could in reality get each one of these cash flows, and if in reality you could invest at 10% interest, that would tell you that this would probably be an okay investment. In Exhibit 6, they've done the same thing here. They've just shown you what they've done in a different format. You still are to the good by $2,900. It amounts to the same thing that we talked about just a minute ago. You're taking each one of your cash flows and multiplying it by the table value amount. The net present value method has some advantages, and the advantages are this: it considers the cash flows of the investment. It also considers that the time value of money is important. If we can invest our cash flows and earn an interest off of those investments over time, the time value becomes very important to us because our investment can grow. It also can rank projects with equal lives using the present value index that is shown in the next section. So let's look at see how they are calculating the present value index. But I guess before that, we should look at the disadvantages. The disadvantage is that, as you can tell, the present value techniques are a little bit more complex to calculate. And sometimes it's hard for us to be able to know what the amount of the interest rate is going to be on our investment. So hopefully we can estimate the amount of the return or the desired rate of return on that investment. But sometimes what we estimate is not valid, and so that can be a disadvantage. Another thing that we could add to the present value analysis for evaluating an investment is in addition to the net present value method, we could look at the present value index. And the present value index is computed with this formula here. You're going to look at the total present value of the cash flows, and then you're going to divide it by the amount that is invested. This is also what the cost of the asset would be. That would give you what we call a present value index. So in the preceding example, if we took the total present value of the net cash flows, the total present value of the net cash flows was $202,900. If we divide it by our amount invested at $200,000, it will give us a present value index of 1.0145, of 1.0145, I should have said. So the total present value is divided by the cost. The present value index on this example is 1.01. Because it's more than 1, it means that you have had a positive net present value. If this had been below 1, we would have had a negative net present value, and we probably would not want to invest in an asset that has a negative net present value. So if this drops below 100%, if it drops to 99%, then we probably will not want to choose this investment to invest in. So the present value index just gives us a different way to look at or evaluate our investments. It gives you something else to look at using the present value techniques. You have to know what the total present value is and divide it by the cost or the initial investment, and that will give you, in this case, an amount that is above 100%. So we would say that this would probably be a good investment. But if you're ranking 2 or 3 investments, you'd want to look at each one of the present value indexes to see which one is the highest amount, and that will help you to determine which method to invest in. So in the next example, they're giving you 3 different investments that this company could possibly invest in. They might want to invest in proposal A or proposal B or proposal C. So what they've done is they've determined the they've determined the present value of the cash flows for each one of these investments. The present value of the first investment was $107,000. The cost of the investment was $100,000. The difference between these is what we refer to as the net present value. So proposal A has a positive net present value, so it may be a good investment for us to invest in. To subject that to further evaluation, we could determine the present value index by taking 107,000 and dividing it by 100,000. It will give us 1.07. Again, the present value index for proposal A is above 100%, and so this would probably be a good investment. That's what the evaluations are showing us for proposal A. If we're looking at proposal B, we have less present value that's associated with it, but we also have invested less money in this investment. The difference is still positive, so that means that proposal B could be a good investment also. But notice when you subject proposal B to the net present value index, or determining the net present value index, we would take the present value of the cash flow, which is 86,400, and we would divide that by the 80,000 initial investment. That's how we got 1.28. A way that we could look at that is we could say this investment will yield us $1.08, but this investment only yielded us $1.07. So right now our best investment is proposal B, and then we would compare that to proposal C. Notice with proposal C, our net present value was negative. So that tells us right there that the net present value is not a positive amount. Proposal C is probably not going to be your best investment. In fact, if you looked at it further, you could see that your present value index dipped below $1. It dipped below 100%. It went to 96%. And so proposal C would definitely be out. So then you could look at these investments and try to choose between the two of those. Because the net present value index was higher for proposal B, we would get $1.08 off of our investment, whereas proposal A was just $1.07. Because we've only had to invest $80,000 in this investment, we most likely would choose proposal B. So what you're going to be doing in this chapter is looking at different investments that your company may make. And then we're going to evaluate those investments and decide which one would be best for the company. Another method that will help us to further evaluate our investments is what we call the internal rate of return method. And on the internal rate of return method, what they're doing is they're trying to determine the rate of return wherein the net present value of the project is zero. We will want to start with the proposals. The net cash flows, always when you're using some type of net of present value analysis, we're going to be looking at the net cash flows. And in this case, we're looking at our net cash flows, and we're going to work backwards to estimate the proposal's expected rate of return. Now, they've given you an illustration here, and they're telling you that the cost of the new equipment is going to be $33,530. They're expecting yearly cash flows of $10,000 each. Because it's an equal amount for 5 years, then we can use the annuity table. We're going to determine the net present value amount first of this investment, this one that we're thinking that's going to cost us, this investment that we think is going to cost us $33,530. You can see in Exhibit 7 that they took the annual cash flows, which is $10,000, and they multiplied it by the table value amount for an annuity. Again, we can use the annuity table because they're expecting $10,000 each year for 5 years. They're expecting an equal amount over a period of time. They're expecting $10,000 each year over 5 years. So this table value amount, if we were investing at 12%, we would go back to our annuity table. This is our annuity, this is our annuity table here. And we were expecting 10% for 5 years. It'll be 3.791. Well, actually, it was 12% at 5 years. So let's go back to our table again, and let's look at 12% for 5 years. Table 4. I'm sorry, I did it again, didn't I? Gotta find your table here. There it is. Exhibit 5 is your annuity table. So for 5 years, at 12% is 3.605. That's where they got this amount here. The table value amount was 3.605. If you multiply that by 10,000, it will give you the present value of the annuity. which is $36,050. The amount to be invested is $33,530, and the difference is $2,520. That's your net present value method. But if you were wanting to look at the internal rate of return, what we will do is we will take the present value, the cash flows, which was $36,050. That's what we found here. And it was based on a 12% return, and it was greater than 33,530. That was the cost of the investment. And so the internal rate of return must be greater than 12%. Through trial and error, the rate of return equating 33,530 cost of the investment with the present value of cash flows can be determined as 15%. And this is how they could get it. The present value of the annuity at the internal rate of return, they were expecting $10,000 each year for 5 years. That $10,000 multiplied by the 15% factor rate or 15% interest rate would give you the actual amount of the cash flows that were invested at $33,530. So when you are calculating the internal rate of return, there's a series of steps that you can follow, and they're outlined in your book for you. First of all, you want to determine the present value factor, which would have been the amount that you had invested divided by the equal annual cash flows. The equal annual cash flows was $10,000. The amount that we were going to invest was $33,530. So if you take $33,530 and you divide it by the equal annual cash flows of $10,000 a year, that will give you the factor that you want to look up on your present value of an annuity table. So if you take the amount to be invested, which was $33,530, if you divide that by the yearly cash flows of $10,000, it's going to give you a table value of 3.353. I know that I'm going to have an expected life of 5 years on the investment. So I'm going to move to my annuity table, which is Exhibit 5. I'm going to go down 5 years because there was a life of 5 years. I'm going to go out to 3.353. And you see that that table value amount, if you scroll up, is 15%. So the internal rate of return is 15%. That was higher than the amount that management was expecting. So that's a good thing. So figure out the internal rate of return. We need to know the amount to be invested divided by the equal annual net cash flows. That will give you a present value factor for an annuity of 3.353. Since you knew that this asset had a useful life of 5 years, you would go to the table, that is the annuity table, scroll down 5 years and across to 3.353, and then scroll up, and that will give you your internal rate of return. And they've given you another illustration here. This is a separate example. They have a cost of $97,360. That's the amount to be invested that they plugged into the formula to determine the present value factor for an annuity. You're going to divide this by the equal cash payments, which is 20,000 in this case, and the time period is 7 years. So we would go to our present value of the annuity table and look up 7 years at 4.868. So back to the annuity table. It was a 5-year life of this investment. No, it's a 7-year, I'm sorry. It was a 7-year life of this investment. And the table value was 4.868, and that would give you 10% as the internal rate of return. And they're showing you the individual steps on the annuity table that I just showed you. There's some advantages of using the internal rate of return method. It considers the cash flows of the investments. It also considers time value money. And it also ranks the proposals based on the cash flows over their complete useful life, even if the project lives are not the same. Its disadvantages is it's complex to calculate, and it also is assuming that the cash from the proposal can be reinvested at an internal rate of return, and that internal rate of return is just an estimate, so it might be valid. So that's as far as I want to go today with you. When we come back in here on Tuesday, I will go over as much of the problem as I can with you. And I will demonstrate them through Cengage so you can see better of what we're doing. It may be that I might have to extend the time period on your assignments, but I'm going to shoot for next Wednesday. We'll see though. So do I have any questions at all right now? the best thing that you can do is just to go back and read your chapter carefully. Practice the practice examples that they've given to you, and again, the next time we meet, we'll actually go over some examples of problems um, that are similar to your homework problems. Do I have any questions at all?